Drewski? Hey, Drewski! Right on, man.
Let's do it. Let's do it live.
Do it live.
How's it going, Josh?
Yeah, man. It's good. Good. I'm trying to fast during Lent on Wednesdays, and I just every day, the next day after fast, I just don't feel great. So, man, bad. You ever just gone a whole day without eating anything? Oh, man.
You know, it's interesting. So I did this like 16-8 fasting for a while.
Fasting? Yeah, I know what you're talking about. Yeah.
And then a couple of days ago, my wife was traveling for work. So I'm like busy getting the kids to school. And I forgot to eat breakfast. And, once I'm at work, I'm just like glued to the seat. So I haven't had a chance to get some food some days till about 2 o'clock. That's the longest I go. I love food, so I can't probably do fasting. That's not.
It's tough, man.
Yeah. Well, we got more than 10 here, so let me go through my disclosures.
Yeah, man.
And it's going to be very important to go through the disclosures today because we're going to talk about product-specific items. So, yes. Number one, we haven't taken your specific situation into account. Number two, this is all educational material. Nothing is a recommendation, advice, or should be construed as such. It's just education. That's all it is. And number three, we haven't entered into a client agreement, so we are just in this phase of education.
Mm-hmm.
Josh, you have anything to add?
I do not. Remember to have people do something else on your website or whatever.
Oh, yeah. If you're watching on Josh's channel, you can also watch on Client First Capital Learning. Yep. It's our YouTube channel. Our website is clientfirstcap.com. And I'll put it in the chat right now.
Ew.
We have a monthly newsletter that goes out all about retirement topics. Please make sure that you subscribe.
All right. Side note, there's another Client First Capital. I don't know if you've seen that, Amar. There's another Client First Capital. That's not you. I kind of chuckled at that the other day.
Yeah. So there's somebody with this Client First Capital website. He's trying to sell the domain.
Yeah.
He wants $3,500 for it. Yeah. You could buy a car for that, Josh. Right. Or you could get a 2-year lease for a Chevy Blazer. That's a long story, but maybe one day we can talk about it on the channel. So let's get into this. So structured notes and buffered ETFs. So, structured notes, buffered ETFs, the concept has been here for a number of years. So I want to say in the early 80s, there were these what were called LLC agreements that Merrill Lynch and Morgan Stanley used to sell, which you could be a limited partner in. And they would have these structured entities where they would buy or come up with the same solution of a structured note, and you would buy into that as a partnership. And then if you look at the 90s, then we had structured products, and there are a ton of structured products. And essentially, this website link here, we'll put it in the notes when we're able, but I'm going to share my screen to the website, right? So it's right here. And what a structured note does is you take your full investment. We put like about 70 to 80% in a bond. And then the rest of the money we buy options with. When you buy options at the end of the structured term, the options have a payout. And that payout is what gives you that alpha or the outcome, right? And sometimes they've set these up in a way that the bond interest gets you 100% of your full investment back. So they were sold as no losses, no potential of losses. But if you're around in 08 and 09, we all know the biggest risk here is the counterparty risk.
Yeah.
Lehman Brothers was the largest issuer of structured products, and they went poof.
Yeah.
And so did all these structures. But I just want to kind of walk through here. There's a lot of key factors that influence structured products. These are the same factors that influence ETF or buffered ETF structures, defined outcomes. So interest rates, credit spread, volatility of the market. So the current VIX influences the pricing of those options. Dividends. So there's a reference asset. Sometimes people use the SPY or the Qs, right? Those pay a dividend. That dividend influences the total return here. Then obviously strike price and liquidity is part of that. There's also leverage structured products, which there's also leverage buffered ETFs, defined outcome ETFs. But I just want to show you, look at the number of structured products that you can buy. They all have a different solution or what. I mean, this list keeps going and going and going. So
Crazy.
You can go to this website, you can click on one of them, and it shows you what that product is supposed to do. So this one, leverage upside, gives you 200% return on the upside, gives you a gap, and then 100% of the downside. Mm-hmm. So there's some protection. On the upside, you get 200% up to a cap of 12.2%, right? So, it's a good website to kind of look at
What's the website called?
We'll put it in the show notes, but structuredretailproducts.com. Yeah. Within their academy, they have the learning side of it.
Gotcha.
All right, so I am going to remove this from stage. Go back here. So remember, structured products, you invest in them, you have a defined outcome, so you know what you're getting. If you're looking at the risk associated, there's obviously counterparty risk. There's no liquidity. I mean, there's all additional risk, but you got to weigh those benefits and risks and kind of weigh them out. Which now takes us to, which I would say is that, all these products, they evolve, right? And so these structured products have now evolved into what I would call buffered ETFs or defined outcome ETFs. And so this shows you the growth from 2018. It was a $5 billion industry. Now it's a $102 billion industry, meaning everybody has their version or flavor of these type of products. And it's been very popular. So I'm going to talk about, just the three key areas that you'll find them. So if we categorize them, you have three main buckets. The first bucket you will find is protection, meaning, hey, I want to be involved in the markets on the upside, but I don't want the downside, right? Or I want to buffer the downside. Pretty good option for retirees or people transitioning into retirement to help protect some of the downside. The second flavor you'll get is income. And income is a big one because income is, most people in retirement are trying to drive income. We'll talk more about these. I'm not the biggest fan of income. Just going to say it, full disclosure, but we'll let you make your own decision. There's also growth ETFs, and growth ETFs give you leverage. So, just like that structured product that we showed earlier, you get maybe 2 or 3 times on the upside. You can probably cap some of the downside or have a 100%. So leverage on the upside, no leverage on the downside, and a certain cap. So how do these work? So I spent a little bit of time this morning using Paint. Josh, have you ever used Paint? Are you a Windows guy?
I'm not. I have a MacBook Air.
Ooh. All right. I'm going to see if I can do this.
I think it goes back to 2012.
Yeah. All right. Well, I've always been corporate life, and all of our programs run off of Windows, so we don't have much of a choice. But all right. So on the y-axis here, we have your rate of return. On the x-axis, we have the actual price index. For this example, we're going to use the S&P as a reference asset, and we're just going to say this is the return profile of the S&P, right? Now, one thing to keep in mind here, most of these structured products or buffered ETFs are on an interval, right? 3 months, 6 months, 1 year, 2 years sometimes. On our examples here, we're just going to use 1 year, okay? So the first layer in all these products is that they're going to say, we're going to invest in the reference asset, but we need to take off, or we need to generate income to provide for the benefits. So what they start with is a cap, right? So if we say, hey, if we give up this upside with this cap, so we're selling a call option, we collect premium, we get that premium, and then we can buy some of the benefits, right? So this cap could potentially pay for buffering the downside. Say, hey, the first 10% loss on the S&P 500, you don't participate. You participate at 11, right?
Mm-hmm.
So if we look at this, if the S&P did, and we can use real numbers here, let's just call the cap 15 and the buffer 10. The S&P does 17%. You're capped at that 15% cap. If the S&P does 0 to 15, you get whatever it gets. If it does 0 to minus 10, you get 0.
Yeah.
And then if the S&P does minus 11, you get minus 1, right?
So it takes 10% off the negative.
Off the negative, yeah. And so that's a big part of this, right? It's like, wow, I can buffer some of the downside. 88% of the S&P's rolling 1-year returns have been greater than minus 10%. So, I mean, you're buffering some of, you're capturing a lot of that buffer. But maybe you're more conservative and you're like, hey, I want to have 0 losses, right? So you can have a floor at 0. So over 1 year, S&P is negative 5%, you get 0. S&P is 0 to 5, you get 5. And if the cap now, to pay for that, the cap is going to be a little bit lower. Maybe the cap's 10%, right? Or 8%.
Yeah.
And so then you get 8% as a cap, and then you get 100% on the of the cap if the reference asset is above that cap, right? Josh, does this look familiar at all to maybe an annuity product that was really popular?
No. I was going to ask you, that sounds a lot like the index annuities that people are trying
Exactly.
to sell.
So this is a way that you can get index annuity type investments with a fraction of the cost and 100% liquidity.
Yeah, I was going to say, without locking your money. Yeah, right.
I think these structured ETFs or defined outcomes are going after the annuity business, right? Because a lot of people buy an index annuity, but then when they have a liquidity event or something, they can't do anything about it. Or you're locked in for 7 years or 10 years. Actually, we just came across somebody that was locked in for 12 years in the index annuity. The other thing in the index annuity, this cap, you give the control of the insurance company to determine your participation rate and your cap rate, right? So like when you buy an index annuity, it says your cap is like 10 and you get 1-to-1 performance up to 10, but they don't tell you how much of that are you actually participating. They control that. Whereas here, there's a lot more transparency.
That's one thing about index annuities, man. They can change that stuff. It's I've heard people say that, like, oh man, they changed my my participation rate and stuff like that. Isn't that crazy?
That is crazy. All right, so now I'm gonna go to back here. So we talked about how the buffered product works. Now I'm going to talk about how defined income works, right? So defined income is just a different animal, if you will, and we need to kind of bring this to a visual, which we'll do as well. But the first step in an income product is that they're going to sell options, 1-year options on the S&P, for example. When you're selling options, you collect a premium. That's step 2. Once you get that premium, plus the money you invested, you're investing that into short-term U.S. bills, right? And the combination of 4 to 5% on those T-bills, plus the option premiums, on average, for most of these, look like they would return a steady 8 to 10% income, and they make quarterly distributions. Here's why I'm not a big fan, and I'm going to share. Well, I guess I have to remove before I can share. And we're getting smarter every day, Josh.
Mm-hmm. There you go.
So this is what the profile looks. No matter what the S&P 500 does above, let's just say the buffer is 10%, right? We're selling those options selling those put options minus 10% from where we're at. You're getting 10% income, roughly 8 to 10%, regardless of what the market does on the upside from that point. But let's say the market starts to slide down and we go down another 10%, you're still getting your 10%. But as soon as we cross over that 10% threshold, now you're getting 1-to-1. You actually own the S&P. Since you sold the put, you're selling the put, you have to buy those shares back, and now you own the S&P and the downside of that S&P. And so that could, for a conservative investor looking for income, this is not good for them, right? Let's see if that's weird.
What?
I don't have to remove the thing when I go back to my slides, but I have to remove it if I'm going the other way around. The one thing that we did not cover is if you looked at the leverage.
Yeah.
So leverage works very similar. You have your cap. Maybe you get 2x upside. So the S&P goes up with this much. You're getting double. You have some buffer on the downside, but then you have 1-to-1 on the downside.
Yeah.
Right. So this is what, if you're in growth mode, maybe this makes sense. But usually if you're in growth mode, you don't want to have a cap. So.
Yeah, 100%, man. That's the cap. If you're in growth mode, that's not good.
Yeah.
I like the initial ones where you just got the you got a cap at 8 and a downside risk of whatever. You know what I'm saying? I used to sell some of these back. Believe it or not, Mark, when I was a broker back in the mid 2000s, we had buffered accounts through. I forgot what bank was. But anyway, I don't think it wasn't Lehman Brothers.
Yeah.
I can't remember, but we used to sell some of these guys. I think it might be Bank of America.
Yeah. I mean, we at American Express Financial Advisors or IDS, we had these buffered CD link notes, very similar concept.
100%. Yep.
But anyways, so I'm going to probably spend the next 5 minutes kind of showing how timing in these products matter. Remember, it's a 1-year term. The options, so this blue line is the option. The dotted line is IBV, which is BlackRock's S&P. You can see there's a lot of disconnect throughout the year, but at the end of the year, they line up, right? So there's an opportunity for arbitrage. There's an opportunity for timing, because timing could give you better outcomes potentially. Want to highlight that you're going to have to track these things. Sorry, I'm trying to share my screen again. So here's another company, Innovator Funds. They have this, they publish their cap rates, right? So remember, nobody knows what the cap rate will be, right? These ETFs, if you buy it and hold it forever, you're just agreeing to whatever the future cap rate is. But on the 1-year anniversary, you could say, hey, I don't like that that cap rate, and sell and not be exposed for another year, right? So these cap rates come out right before. So this is for April. So they're saying this is what they're estimating the cap rates to be.
Oh, baby.
Right?
So you don't know what the cap rate is before you invest in it?
You know the range or the approximate cap rate. So let's say brand new product, you know what the cap rate is.
Okay, gotcha.
Then 1 year goes by, and now we're like day 20 T minus 25 to the 1 year expiration. We're projecting what the future cap rate is.
All right, so these don't mature, and they can continue on.
They can continue on, right?
So you can have mature. Those CD link ones they sell actually had a maturity date.
Yeah, okay, exactly. Not here. So these keep rolling, if you will.
Gotcha.
Right?
Okay.
And so that's why I'm saying this could be like your index annuity, where you just keep rolling it, and then when you need money, you just time it with the anniversary date, and you just take some out. So here. There is a timing element. So if I change my screen, does that come up? No. All right, hold on. Gotta go back here. So there is a timing element, and you can see why there's a timing element, because the blue line and the dotted line, there's a disconnect, right? So let's just say if the market moves sideways, well, your cap could probably be the same as day one, and the only difference there is that you have less days to expiration, which is amazing. You're getting the pricing of a 1 year CD for like maybe 6 months, 3 months, whatever that remaining amount of time is. If the markets go up, you probably don't want to invest in one of these buffered ETFs because the caps are going to go down, right? Because the reference asset has gone up as well as those options. And then you're going to have less than 100% protection on the downside, potentially, right? On these buffered ETFs.
You're talking about investing in one that's already been issued.
Exactly. Yeah, and I got some examples, and maybe Josh, in the interest of time, I'm just going to hop right to that.
Yeah.
So if the market falls, right, you could potentially have a bigger cap and still have 100% downside. So let's look at some examples of this. Stop, share. I'm just going to do my whole screen.
Okay.
All right. So this is BlackRock's version of this. They got, on the buffer side, they have 3 different versions, right? So we've talked about income. We're not talking about income. We've talked about the growth where it's like 2x on the upside. We're not talking about them. We're talking about, for BlackRock's purposes, they have 3 levels of downside protection. So let's look at the December one. There's 287 days left in this interval, if you will, right? So if you bought it on day one, your cap would have been 7.9 and your max downside would have been minus 0.5, basically 0, right? If you buy it today, because of, we've gone through this downward market volatility, you buy it today, your upside is 8.01, and then your buffer is 99.6. So your downside before the buffer kicks in is gone down by 10 basis points.
Yeah. All right, guys.
Right. And this logic is true. For a lot of these that you can look at. So let's look at something that's like moderate, right? This started off with a 4.84% cap, and at minus 0.1, you had a buffer for 5%, and now you have more upside, and you have 2.33% of a buffer, and then you have 100% downside protection, right? Josh, am I not explaining this? Let me try this one again.
Yeah, I'm confused.
Okay, so the buffer is 0 to 5%.
All right.
So the reference asset is in that range right now, right? We can see that with this dotted line, if you will.
Right. Gotcha.
But you don't have to be exposed to that whole buffer. You just need you get 2.3% where you're exposed to it, and then after minus 5%, you get all that protection, right?
Yeah.
So
I guess what I'm saying is, why would anyone do that one over the one you just showed, which had a less a downside risk and a higher cap? You see what I'm saying?
Well, that's my whole point. So when we look at these products that are different in time horizon and different intervals.
Right.
So like Innovator has on their website, they give you days to expiration, where the reference asset is, how much buffer you have, and what the cap is currently.
Yeah.
Sometimes a more conservative product like max downside protection
can
give you a higher upside cap than some of these moderate ones as well.
Interesting. Yeah, that's an arbitrage you're catching there, I guess.
Exactly. So there's an opportunity for arbitrage. So if you like this downside protection, in one of our models, which is the defined outcome model, we're tracking this to see where can we get some alpha in these defined outcome buffered ETFs.
I got you. All right, right on, man. Yep, you're just catching at the right time. Exactly.
Yep.
Now they don't mature. They just continue to renew every, you know what I'm saying?
Yeah, every year. I mean, so what I wanted to compare here. So this was the December BlackRock one, DMAX.
Yeah.
This is the Innovator defined outcome 1 year protection. This is 8.06 with 100% downside. This one is 8.01, right? So the pricing of these have gotten really competitive because now it's all fully transparent. So now with the defined outcomes, you have lower fees than you had in structured products. You have higher liquidity, and you don't have counterparty risk being one bank.
Yeah.
You have the market makers and the options chain, which is essentially the whole market, right? So I'm going back to here. Like I mentioned earlier, we manage two portfolio strategies. One is called defined outcomes, and about 40 to 60% of it is geared towards these type of buffered notes and making sure we know what the outcome will be in those type of products. Our goal is to preserve. If your goal is to preserve, protect, and compound, some of these defined outcome ETFs actually have that built into it, right? So it's something really good to look at and kind of discover to see if it's a right fit for you.
Yeah.
Again, if you have questions, you can reach out to us on our website, and we'll be happy to help. So with that, we're about 1 minute and 20 seconds over. Let's get into some questions.
Yeah.
You start from the beginning?
Yeah. I thought, well, you got some questions on your end that I can't see.
Oh, you can't see the questions? All right.
I can see what the people on Heritage Wealth Planning had put on here.
Yeah. I predict the market will go down, up, and not necessarily in that order. Yes. Nobody has a crystal ball. I got this magic 8 ball.
Yeah, right. The magic 8 ball tells all. Exactly.
Yes, it does. And even with this, maybe I can push back a little. The options market and the structure of the market creates levels of resistance and levels of support. Those change over time, but if we're at the edges of those, or you have a higher you can look at probabilities to kind of define which way the market will go. Yeah. In that sense. So we got the website for the structured products. The other websites was innovatoretfs.com and iShares.com for BlackRock.
You got tickers?
We have, if you go to, I can't give you tickers because that's considered a specific product.
I'm just saying, but they do have like tickers.
Yeah, they're publicly traded. And, I can just pull up for an example. If we pull up on TradingView, if we look at something like, let's look at MaxJ with the max downside buffer. I think what will be good to show here is that we look at this over, this one started in July. So add to stage. Is it adding? Nope. All right, how do I add to stage? Remove, add. There we go. So this is the July product, right? You see a high amount of volume here initially, and then the volume drops off. There's a little bit of volume here, but then it drops off. So like these products, usually you see a cluster of volume around the expiration date, the 1 year term, and then you see very little volume. Here's somebody probably, needed some liquidity, and then they sold some, right? Right. So yes, this is fully transparent. You can track it through
at Bloomberg. Is that what you're looking
at? This is TradingView, but yeah, you can look at it on any website that you use. What are the names? Okay, so we got First Trust, we have Allianz, we have BlackRock, iShares, we have Innovator Funds, we have Oppenheimer has some. So everybody has their own flavor of them, right? So there are tons of them out there. If you need help, we can help you research and find the right ones for you. But a fund that focuses on selling covered call strategies accomplish similar outcomes and potentially. So covered calls, what we're doing with covered calls is you own the reference asset and you're trying to drive income by selling calls that are out of the money. You're collecting that premium, that premium, you keep the asset, and you're getting more income, right? Is a way of creating more alpha. Here's the problem: is if you're an income-based investor and you're doing that for income, what if your reference asset drops significantly?
Yeah, 100%. Exactly. Still downside.
Right. So we don't like to use that too much to drive income.
Yeah, you still got a downside risk there, man, because you still own the shares, and if the shares fall, you might have gotten a little bit of extra income, but you're still in Tesla stock right now, going down like a friggin' like a brick, that's for sure.
So a couple of things is that when you're looking for income, don't look at just the income, look at the total return.
Absolutely.
Right?
Absolutely.
So the total return equals the market participation and the income gives you your total income, total return.
A lot of people make that mistake. They just look at total income, like, I'm getting 11%. You're like, did you look at the share price? No.
Even with popular large cap companies like AT&T, right? You could see the share price drop by 30%, like AT&T has in the past, but you can be saying, I'm still getting my 11% income. Like I still got that good dividend. But yeah. Any other questions?
Looks like that's it. So remember, what's your website again, Amar?
ClientFirstCap.com. We have a newsletter. Please subscribe. Our YouTube channel is called Client First Capital Learning.
Go to Amar's website, or I can't say it. Don't go to.
Nobody's watching this far, anyways, right? So you can go to our website, subscribe to our newsletter. You can go to our YouTube channel, subscribe to our channel. We try to put out a video or two a week, and it's usually good content. Thank you for watching, and stay tuned to next time. We're at a half an hour. All right.
Thanks, guys. See you tomorrow.
Bye.
All right. Bye.